Welcome back to MB Capital Strategies. Today we continue with the mining series. South32 is one of those resource companies that many investors completely misjudge. It's not a high-yield dividend story, not a single commodity risk, not a gold or commodity hype, but rather a broadly diversified resource company with aluminium, bauxite, manganese, silver, copper, and also nickel. Currently, as of January 2026, the stock is trading at around €2.35. After a longer consolidation phase, it's once again near the upper end of the recent range. South32 has a net cash position of around $123 million. It consistently generates over $1 billion in operating cash flow per year, yet is still traded at a fair but by no means ambitious valuation level. Today it's not about storytelling, not about ESG narratives, and not about dividend promises. Today we are looking exclusively at what matters in the long term, and that is cash flow, the balance sheet, dividend logic, and cycle positioning. So the central question is South32 merely a cyclical cash flow component, or is it an underrated commodity compounder for the next industrial wave? Here as well, let's first take a look at how I am invested. I hold a small position, a total of 76 shares. My entry price was €1.68, a total of €127.36 invested, with dividends of €2.39. Currently, with an internal rate of return of 36% and an unrealized capital gain of €44.40. The 52-week low and high are between €1 and €2. Currently, we are at €2.22. According to investing models, our target here is €2.63. For all my fundamental data, I use Investing Pro for analysis. If you also want to use this tool, you'll get a 15% discount through my affiliate link. The link is provided below. South32 is deliberately not a single commodity player. The business model is structured so that no single raw material dominates the overall results. The most important revenue and earnings drivers are aluminum, bauxite, manganese, silver, lead, and copper nickel. It's important to note, South32 is more industrially cyclical than gold producers, but at the same time more resilient than pure single commodity miners, because weaknesses in individual markets are offset by other segments. Specifically, this means it benefits from industrial economic cycles, demand from China, and also the energy transition, suffers more during global recessions, but remains operationally stable thanks to diversification and cost structure. A look at the revenue development, rounded to millions, and in US dollars, in 2022 we are at $9,450,000. In 2023 at $7,430,000 and in 2024 at $6,810,000. And for the 2025 fiscal year, approximately $7,300,000. Compared to the previous year, this corresponds to a growth of 7%. And this is not a structural downturn, but rather a clean cyclical normalization. End of the commodity supercycle. Price declines in aluminum and manganese, while at the same time production volumes are increasing. The examples here are aluminum production, which increased by 6%, and copper production, which rose by 20% in 2025. 2025 thus clearly shows the bottom has been reached and a cyclical recovery is visible. Additionally supported by portfolio optimization, such as the sale of Ilvara coal. Now let's move on to the crucial question. How well does South32 perform in a weaker cycle? And here are the figures for 2025. Underlying EBITDA is approximately $1.93 billion. This corresponds to an increase of 7% compared to the previous year. Underlying earnings of approximately $666 million, and the operating margin is around 26%. And this is not a boom level, but the crucial point is no stress zone and no destruction of capital. South32 remains clearly profitable, keeps margins stable, and benefits from cost leadership in the aluminum segment as well as very competitive manganese assets. Additionally, in 2025, $579 million in costs were saved, and this is exactly where quality separates itself from mediocrity. Now to the core of the investment thesis, namely the cash flow. We have an operating cash flow in 2023 of $1,090,000, in 2024 of around approximately $1,040,000, and in 2025 of approximately $1,190,000. The free cash flow after capex in 2025 is around approximately $285 million. That is an increase of $272 million compared to the previous year. Capex was around $1 billion, including growth projects like Hermosa. South32 does not burn cash during the down cycle. On the contrary, the net cash position improved by $885 million and currently stands at plus $123 million. This is exactly the kind of behavior you want to see from a well-managed cyclical company. South32 is not a high-yield stock, nor does it aim to be one. The current key figures are a dividend yield of around 2 to 3%. The payout is variable and fully franked. No dividend guarantee at any cost. In practice, it looks like this. In boom years, there are special dividends, and in weaker years, there is a reduction instead of a debt-financed dividend. A total ordinary dividend of around $294 million, an H2 dividend of about $117 million, which is 2.6 cents per share, plus additional share buybacks of over $56 million. So what is the key takeaway here? The dividend is a bonus, not the reason to buy. South32 optimizes total return, not smoothing out dividends. Now let's move on to the 2025 balance sheet check. We have net cash of around $123 million, a debt to EBITDA ratio of about 1.3. We have no refinancing risks. We have high flexibility for M&A or buybacks. This is top-tier balance sheet quality for a commodity cyclical. No pressure, no emergency dividends, and no dilution. The current valuation, we have a forward PE ratio of about 15 to 18. We have an EV/EBITDA of about 7 to 9. We have a normalized free cash flow yield of about 6 to 8%. This isn't a bargain like classic high-yield miners, but you get a lot in terms of diversification, balance sheet strength, and cycle upside from industry and the energy transition. What are the risks here? Of course, there are also risks such as a global industrial recession, weaker demand from China, commodity price volatility, and Mutsal aluminium. Power contract ends in 2026. Possible care and maintenance, 10 to 15% output risk. One-time costs of around $60 million. Important, earnings volatility, not balance sheet stress. So, what is my conclusion? South32 is not a high-yield dividend stock, not a hype commodity, and not an ESG flagship, but rather a cyclical cash flow producer with a very solid balance sheet and a clear leverage on industrial cycles and the energy transition. My assessment, South32 is not suitable as a dividend anchor, but is very well suited as a cyclical commodity component that you build up counter-cyclically and then reap the rewards in the next commodity upswing through price gains, dividends, and buybacks. That's it for this video. As always, this is not investment advice, but simply my personal strategy. I look forward to seeing you again in the next video. If you enjoyed the video, feel free to leave a like and subscribe to this channel if you haven't already. I appreciate any interaction with you, so please feel free to leave comments as well. I will respond to every comment. Until then, successful investing.